let me explain to you what the old versus the new is so you can have an understanding of some opportunities that exist in these scenarios. If you're looking on screen, we're looking at a scenario of a family of four. And you look at that family of four, you have the first partner in the relationship who has $100,000 adjusted gross income. And partner two is the person who actually has student loans and they have a $50,000 adjusted gross income. So you can see why they would consider filing separately and not have that spouse's income included. As a matter of fact, the first scenario that we're looking at on screen, and this is assuming that they're using either the pay-as-you-earn plan or the new income-based repayment plan. If we filed jointly with this couple, they would have a combined adjusted gross income of $150,000. And since there's four people in the household, they would get to subtract 150% of the federal poverty level for a family of four. But at that high adjusted gross income of $150,000, it leads to a student loan payment of $848 a month. Conversely, let's assume that they decide to file married filing separately. And they file married filing separately, the Department of Education has confirmed that that partner who makes $100,000 of adjusted gross income will not be included in the calculation. So all that's left is the adjusted gross income of the partner who makes $50,000. Now, in the Biden administration, they instituted a change that said, what we're going to do is when we calculate your federal poverty level for couples who file separately, we're going to remove the other partner's income, but we're not going to allow you to use that person in terms of a number of people in the household. So if we had a person who has a $50,000 adjusted gross income, in the Biden administration, they would get to subtract 150% of the federal poverty level for a family of three. And it would lead to a student loan payment of $83 a month. Now, that's still a tremendous deal. Remember, if they filed together, they would pay almost $900 a month. And by filing separately, they're paying less than $100 a month. They're paying $83 a month. So that's a huge opportunity. However, it is not as big an opportunity as how it worked before the Biden administration, because before the Biden administration, you were allowed to file separately. And you not only could exclude your partner's income, but you could include them as a member of the household. So if we do that same calculation, $50,000, now we get to subtract 150% of the federal poverty level of a family of four. And instead of paying $83 a month, we pay $15 a month towards these student loans. So imagine if you're someone in this relationship where you're making $150,000 as a couple, but based on your tax filing strategy, you could be pursuing public service loan forgiveness and paying $180 a year towards your student loans and still get credit towards the 10 years that you need for PSLF or the 20 or 25 that you need for income-driven repayment. So while there are a lot of things that are not opportunities anymore, like, for example, using the SAVE plan, being able to go back to the old rules of calculating married filing separately for student loan payments is a potential opportunity for federal student loan borrowers in this scenario. And it's bringing up a lot of strategies that people used to use. So number one, it being more prevalent that people use the strategy in the first place. You also see people who will tell you like really complex strategies that, to be transparent, I'm not really a fan of. So for example, you can have a return that is married filing separately, and you can amend that return after it's filed to married filing jointly. So what some people would do is they would file married filing separately when it was time to recertify their student loan income. And then once their payment was set for the year, they would just amend their return and file married filing jointly, and they would get back those extra tax dollars that they had to pay. Now, that is easier than doing it in the reverse and going from married filing jointly to married filing separately. Because after the return deadline has passed, you can't amend a married filing jointly return to married filing separately. So it's a lot of semantics in terms of the order of doing things and tax strategies. To be transparent, I think that is more complex than the average person should be pursuing. But the point of the matter is there are more opportunities and more potential savings based on this calculation of married filing separately as compared to what was instituted during the Biden administration. So what I would say, in spite of tax complexity, I wouldn't be looking at all those like, oh, I'm gonna file this way, then file that way. But if you're even considering this, I would be on the lookout for a tax professional that could help you with some of these considerations, because it could make a tremendous difference in your student loan payment on a monthly basis. So those were some of the updates that I think were valuable. I really don't know how quick it is. I haven't been looking at the clock, but I know this is more of a rapid fire episode than we always do, but hopefully these things were valuable. We'll be back in 2 weeks with some more student loan information that will help you have that loan balance forgiven, reduced, reorganized, or expedited. I'll see you then. From Escape Student Loan Debt, this was the Escape Student Loan Debt Podcast, a show for established professionals whose student loan payments or loan balances are impacting their marriage, their business, their credit, or their dream of achieving homeownership.